Hi, I'm Chris Matheson, a member of our merger arbitrage investment team here at Gabelli. I wanted to walk through an example of merger arbitrage and how we earn a return by investing in global mergers and acquisitions. Merger arbitrage is an investment strategy that focuses on shares of a public company that have entered into an agreement to be acquired. In this example, we'll look at an all-cash transaction of a U.S. publicly traded company. On December 30th, Company A closes at $25 per share. On January 2nd, the company announces that it has entered into a definitive agreement to be acquired by Company B for $50 cash per share, or 100% premium to the previous day's closing price. The first piece of information that we look for as merger arbitrageurs is the deal announcement press release, which highlights the terms of the transaction, why the companies have decided to enter into this agreement, the conditions to close, and an estimated time frame for completion. In this situation, we know the deal price is $50 cash per share and is expected to close in 3 to 6 months after receiving Company A shareholder approval and regulatory approval. The next document that will be released is the definitive merger agreement, which outlines the terms and conditions by which each party must abide throughout the agreement. Following this announcement, shares of Company A will trade up, but remain just below the $50 per share. Shares will trade at this discount or spread to the ultimate deal price because of a few factors. First is the risk-free rate, or the rate you would earn on a risk-free investment, generally a U.S. short-term treasury bill. Next is the risk premium, inclusive of deal risk and the time to close. Deal risk encompasses potential complications that may arise during the transaction, including regulatory approvals that need to be received in certain jurisdictions, shareholder votes that need to be attained, or potential financing that needs to be secured. These are all deal-specific risks that we monitor during the transaction. And the final element that makes up this spread is the time value of money, or how long a transaction will take to close, which on average is around 90 days. Because of these elements, the stock of Company A begins trading after the announcement around $49 per share, a dollar or 2% below the ultimate acquisition price of $50. Once we have an understanding of the transaction, the buyer and the seller will determine at what price we will purchase shares of Company A in order to be adequately compensated for taking risks associated with the transaction. On February 6th, Company A releases its preliminary proxy statement. This statement has several critical details for us to review, including the background of how the agreement came together, financial projections by the management team, and the status of required regulatory approvals. Company A discloses that it began exploring strategic options for the company a year ago and ran a targeted sales process contacting 12 parties. Company B had offered the highest price through several rounds of negotiations and due diligence. Also outlined in the proxy statement is an update that the parties filed their HSR notification on January 16th, with the 30-day HSR waiting period set to expire on February 15th. This period restricts the parties from closing the transaction prior to an initial review by the Federal Trade Commission, FTC, and the DOJ, the Department of Justice, to evaluate the transaction for potential antitrust violations. On February 20th, the company files its definitive proxy statement, setting the shareholder vote date for the transaction for March 26th. They also disclosed that on February 15th, the waiting period under the HSR Act expired, meaning that the FTC or the DOJ did not believe the proposed transaction would cause any antitrust violations. Because of this, the stock has tightened, closing closer to the final deal price, reducing the spread to 44 cents. On March 26th, the shareholders of Company A vote in favor of the transaction, the final major hurdle before the deal can close. Company A later discloses that they expect to close the transaction on March 28th after completing all the necessary conditions. Company A trades for the final time, and on the 28th, the deal is completed with shares closing at $50 per share. Shareholders of Company A will receive their $50 cash per share, and Company B will assume all the outstanding shares of Company A. Over the course of the year, we see hundreds of publicly traded companies enter into agreements to be acquired, and our job as merger arbitrageurs is to build a portfolio of target companies which we feel have the highest probability of closing, gradually scaling into positions over time. Building a well-diversified portfolio of similar transactions helps us to generate consistent, risk-adjusted returns with a focus on compounding and preserving capital. We'd be happy to discuss our merger arbitrage strategies in more detail or answer any questions you may have. Thank you.